the bond market continues to melt down. I wanted to do a kind of quick emergency update. Might do another video later towards the end of the day, but um, just as we predicted yesterday evening, the 10-year at New York Open is now higher than where it was last night. And since close yesterday, the 10-year is now up 10 basis points. 30 years up as well, 2 years up marginally, but this is pretty incredible. I think we are getting pretty close to a level that the Federal Reserve will have to step in. There's really no other way to stop this degree of dumping of U.S. Treasuries. The dollar is down again sharply today, and the Swiss franc, and the yen are both up versus the dollar. So here we see the franc, and remember this is US dollar franc, so down means franc strength, dollar weakness. This is the CNH. Let's put the yen. So this is US dollar yen cross. Again, same concept, dollars numerator. So as the line goes down, that is yen strength. Here's the curve. So this is incredible. The curve is steepening wildly. This is incredible. This is the exact opposite of what you want to see going into a recession. So what is a curve steepening? There's a bull steepening and a bear steepening. What we are seeing recently over the past week or two, maybe longer, maybe close to a month, is a bear steepening. Well, what does that mean? What's the difference? So a bear steepening of the yield curve is where, remember, yields are inverse to bond value. So this shows you the bond value of a long-term treasury. TLT shows 20-year treasuries, 20 and 30. A bear steepening is when long-end bonds, 10, 20, 30-year bonds are selling off more than short-term bonds. And this is the exact opposite of what you want to see heading into a recession, heading into a nominal growth scare. This is the exact opposite of what you would expect. Also, heading into a growth scare, nominal growth concerns, this move in the dollar is the exact opposite of what you would want to see. And historically, what we have seen. So historically, long-term, U.S. Treasuries kind of writ large get bid, right? So going back to TLT, Treasuries get bid higher, bond value up, yield down, and historically you would also see the dollar get bid, dollar strength, heading into uncertainty, nominal growth concerns. Kind of pick your adjective, but clearly we are in the midst of a global trade war. I would argue it's entered a capital war, currency war phase. But and we've also had these huge headwinds to growth due to taking the average weighted tariff from 2% to 25% if you include China, which again, China is 25% of our trade. About a quarter of our trade is with China. So you cannot say, well, he reversed the tariffs on the rest of the world, so everything's gravy. Well, he sort of did, but the average weighted tariff is still 25%, and for decades it was 2%. So, again, we are clearly in a huge nominal growth shock in a negative direction. And so you should be seeing the dollar rally. You should be seeing long U.S. Treasuries get bid, meaning rates down. The fact that we are seeing the exact opposite is what is concerning. The sharpness of the move. So again, remember, when you see these rates, the bond value is opposite. It's inverse to that. So this might help visualize it a little bit easier to see kind of what's functionally happening, which is, U.S. Treasuries are getting dumped. I mean, just in the past, this is a 2-day chart. We'll go the daily. Yeah, wow, look at that. So since Friday's open, the TLT is down 9%. The most liquid market in the world is down 9% in the matter of, 5 trading days. The collateral for the entire global financial system has lost 9% of its nominal value. Now, remember, if you're a hedge fund or an institution, you are levered, right? Treasuries are your collateral. You take those treasuries and you use them as collateral for leverage to take on more debt so that you can buy NVIDIA, right? Or buy the S&P 500. You finance the purchases of treasuries in the repo market. You take those treasuries and you pledge them as collateral. Well, imagine, right? Think of it this way. You're an everyday American. You get a home equity line of credit. You are pledging your house as collateral for, call it, I don't know, $300,000 of home equity, a line of credit. What happens if your home price, now imagine that your $1 million home that you just pledged as collateral, now imagine that 5 days later, that $1 million home is worth $600,000. I'm just using extremes to hopefully visualize, hopefully paint a picture in a way that everyday people can understand. Treasuries are the global collateral with which everything is based off of, and they have just plummeted in value just in the past 5 days, 5-6 days. This is already starting to break things. I'm convinced. I was trying to not be too hyperbolic in the past week, but like we're getting to a point where things I can almost guarantee are starting to break, because there is no other way, given, for example, the basis trade that everyone keeps talking about. This is where you hedge funds, for example, through the repo market get financing. They buy US Treasuries, right? Cash securities, US Treasuries, actual Treasuries, and then they pledge those Treasuries as collateral, and they lever it up 30, 40, 50, 60x. Well, the value of their collateral that they were using just plummeted in value. So again, hopefully that clarifies, paints the picture for kind of people that aren't, colossal macroeconomic nerds. This is incredible what we're seeing. And the move index hasn't updated. I expect the move index, if this move continues, the move index, which is the volatility for the bond market, I expect this thing is, over 140 easily, if not 150, 160. Yeah, this is just incredible. Gold is absolutely ripping. It was just at a new all-time high when I started the video here. I got up to 32.44. This is incredible. Like this gold chart, here's a 5-day chart. So in the past 5 days, gold's up 9% almost. When it was at the high, it was probably up 9% in 5 days. Even now that it's pulled back, it's up 8.5% in 5 days. Gold is up 8.5% in 5 days. I have been saying on X that I've thought that gold looked like it was ready for kind of a the last blow off top sort of huge, insane sort of move to the upside. I've been saying that for probably a month or so. It looks like we're starting to get it. Look at this thing. This is incredible. This is one of the strongest looking charts I think I've ever seen. This is definitely concerning if you're a central banker. If your entire net worth and reputation is tied to the fiat system, this is concerning. Remember, gold, when you're long gold, you are basically short USD. You're short dollars. You're short on the fiat system. And what we're seeing is the starting throes of things starting to break in that fiat system. Speaking of the fiat system, let's look at Bitcoin. So Bitcoin looks like it wants to break out to the upside out of this downtrend that we've been noting. It's shown pretty incredible strength here. And it is on a day where QQQ is basically flat. QQQ is up 0.07% as of right now. And Bitcoin, on the other hand, is up 3.5%. So we expect Bitcoin will, this is part of the reason we've been so bullish on Bitcoin. We expect Bitcoin to kind of catch up, you could say, to gold. It serves the same purpose at the end of the day. Here, let's look at the Bitcoin NASDAQ cross. Yeah, so Bitcoin in NASDAQ terms is up 3.7% today. So we had noted here that this thing looked like it was on the longer term timeframes, looks like it wants to rip to the upside, the Bitcoin over NQ, over NASDAQ. And yeah, we still expect that. We still expect that, US equities will do poorly in kind of the current climate. To be honest, SPY and NASDAQ look pretty bad. I don't know. I don't know where this thing goes from here. I don't know. But I do think that we are relatively close to intervention. And now, what will that intervention look like? There are a number of possibilities, as we talked about on my space last night. There is this kind of, long talked about possibility of the supplementary leverage ratio being exempt, U.S. banks being exempted from that SLR requirement, which would basically free up balance sheet capacity for them to buy U.S. Treasuries. That's certainly one possibility. Another possibility is the Fed cuts interest rates. What happens if the Fed cuts interest rates? This is what you see in Turkey, right? Turkey is going through a fiscal crisis, balance of payments crisis, or Argentina, right? Central bank, what do? They cut rates. And what happens to the long end of the yield curve? It goes parabolic. Yields rip. People dump bonds even harder. So I think they're smart enough to I would hope that they are smart enough to understand that if they cut rates, they will completely lose the long end of the yield curve. I hope they are smart enough to recognize that. Remember, guys, like I am just a nerd. I don't have a PhD in economics. If I can understand this stuff, if I can accurately forecast basically everything that's happened over the past, 3 months, I would hope that the smartest economic minds in our country at the Federal Reserve can understand what a balance of payments crisis is, and the fact that the U.S. is behaving more like an emerging market than the reserve currency issuer of the world. That is what we are seeing. Let's look at the Swiss franc. Yeah, this thing. So remember, this is dollar Swiss franc as we covered in the beginning, and this is now, I think, the strongest that the franc has been since the debt crisis in Europe. And remember, something else that's maybe interesting, worth going over. Everyone keeps talking. If you're familiar with the dollar milkshake theory, Brent Johnson, I have massive respect for him. We're, I think, both fans of each other's work, I would hope is safe to say. And I think we generally agree that the euro-dollar system, the structure of the system where there are hundreds of trillions of dollars of dollar-denominated debt. And remember, there is only, if you use M2, there is only $21 trillion of actual M2, actual money. And if you go to the monetary base, this is the M0 money supply, there's only 5.6 trillion. So there is only, there's much less actual money than euro-dollar debt, right? And so the theory of the dollar milkshake is that there's so much dollar-denominated debt out there in the world that in the event of a crisis, the dollar would actually strengthen, right? Because that debt gets called against the monetary base, which is significantly smaller. Okay, so if that wasn't detailed enough, please let me know, or maybe go check out Brent Johnson's work. He's great on euro dollar. Here's the thing. uh, I've generally agreed with that take that we would see a dollar strengthening because of those euro dollar debts. But now I want to try to paint a picture. So, say you're a German business person. You own a business in Germany. You make money in euros. Now, say you go and take out one of these euro dollar loans. So now you owe $1 million. You take $1 million loan out. So now you are short 1 million USD. Well, if the dollar strengthens, as it has generally done, historically speaking, if the dollar, does, here's a trade weighted dollar. If the dollar goes up and to the right, that $1 million loan that you took, unless your income in euros is increasing at the same rate that the dollar is increasing versus the euro, that loan you just took out, that debt is getting bigger effectively. Now, that's kind of historically how it's worked. Now I want to kind of paint a picture. So imagine you're that same German business owner. You have that $1 million loan, but instead of using the dollar as a carry trade, I want you to imagine that you go into the Swiss franc, right? Here, we'll do this so it's kind of easier to hopefully. This is what the Swiss franc looks like, right? If you buy this currency, which I'll note is one of the few currencies that's appreciated versus the dollar, if you convert your euros, your assets, right, your liquidity, if you convert it to the Swiss franc, which is appreciating versus the dollar, that $1 million loan that you took out is getting smaller. So historically, the euro dollar system worked under this regime where the dollar would always go up versus pretty much everything. So, all these euro dollar debts, which I totally agree, there are a huge number of euro dollar debts, dollar based loans. Those are getting harder and harder to service under the old regime. Well, under a theoretical regime, right? We'll just throw it out as a theoretical for now, where say the Swiss franc is kind of the global safe haven and everyone is flocking to the Swiss franc. You convert your liquidity, your euros, whatever you're earning in, to the Swiss franc, which is getting stronger versus the dollar. All those euro dollar debts, that $1 million loan that you as a German business owner have taken out, that $1 million loan is getting smaller. So in fact, you're not getting squeezed. In fact, if anything, you are incentivized to wait. Brent Johnson's theory and the dollar milkshake dictates that a global dollar squeeze, right? They are short dollars because of the euro dollar debts. If the dollar starts to run up, if the dollar starts to get bid and strengthen, they will basically go through a short squeeze, right? That's basically kind of the concept. Well, in this world, in a new paradigm, a theoretical paradigm, we'll say for now, where the Swiss franc is kind of, strengthening versus the dollar, you are incentivized as that German business owner to hold on, just wait. It's kind of the opposite of what the dollar milkshake would indicate, which is you get short squeezed, right, on your dollar-based debt. You need to rush out to buy dollars because your debt is getting bigger and bigger and bigger. Every passing day, the dollar is ripping higher. Your debt is getting bigger. That's a short squeeze. Well, this is the opposite. Again, theoretically, I'm not saying it's 100%, happening or anything, but just theoretically, if the Swiss franc, if you converted, your assets, your net worth into the Swiss franc, well, that dollar-based loan, that euro dollar loan is getting smaller. And so you are incentivized to actually kind of hang out. It's kind of the exact opposite of getting short squeezed. You're patient because look, the Swiss franc keeps appreciating versus the dollar. So you just hold your money in the franc and boom, that $1 million loan that you took out from the euro dollar system is getting smaller and smaller and smaller. Same thing with gold, right? Remember, like we mentioned, 5-10 minutes ago, gold is basically an expression of a short US dollar, short fiat. sort of expression, right? So if you take out that $1 million loan, but instead, you're that German business owner, you take $1 million euro dollar loan out. Okay, now you're short US dollars. Well, if you convert your liquidity, your net worth, your assets to gold, and gold appreciates versus the dollar, again, it's the exact opposite of the old regime where the dollar you get short squeezed on your dollar debt. If instead you're converting to gold or the Swiss franc or something like that, look at this. This is gold, right? Another way to frame it is this is the dollar versus gold, right? So the dollar is dumping versus gold. So again, you're incentivized to actually hang out. If anything, less pressure is being put onto you because you are long gold, meaning you are short, US dollars, and that trade is working for you. So that $1 million euro dollar loan is getting smaller. So, I'm not trying to say that Brent Johnson's theory is proving to be incorrect. I think it's still too early to say, but I think it's an important concept to at least start to address. I haven't really heard anyone kind of bringing that argument to the dollar milkshake theory. So again, massive respect for Brent, and I've been following him for a long, long time. But I think that just objectively, this is a concept that we should at least kind of start to talk about in terms of what's going on, because we are seeing in my opinion, once in a generation moves. The bond market, the moves that are happening in the bond market, which is the largest market in the world, the most liquid market in the world, apparently, right? The collateral for the global financial system. We are seeing it just completely melting down. This is the monthly chart. Let's go to the daily. I mean, this move is just insane. Look, there's really no, I'm trying to come up with the words to say, but things are getting kind of spicy here. And again, look, the VIX is above 45. The VIX has stayed elevated. Like normally you don't see that. Like on the daily chart, normally, and we talked about this in the weekly update a week ago, normally you get a spike like this, right? And then boom, and it just gets slammed right down. But what do we see? Yeah, the next day it kind of opened lower, pushed higher. But then that next, that big rally, right? It did start to look like it was getting slammed down, and okay, VIX is going to collapse. Volatility is collapsing. All those short vol traders, right? Short volatility guys, they're all coming in and shorting volatility. Okay, kind of coast is clear. But over the past 2 days, we've seen the VIX kind of like hang out above 40, which is pretty high for it to just be hanging out here, and if anything, headed higher. It looks like so that's notable. Yeah, the fact that the yen, I think we mentioned it earlier in the video, but the fact that the yen is acting as a safe haven bid is pretty insane, given the fiscal situation of that. In my opinion, the yen just shows the degree to which the issues in the dollar are meaningful, right? Like the fact that the yen of all currencies is acting as the safe haven, which used to be the dollar, given its fiscal picture, is just incredible. And we had cool CPI and cool PPI today, right? Bonds should be getting bid, not sold, not shorted, not headed lower. Bonds should be getting bid on significantly cooler consumer price inflation report, producer price inflation report. Now, granted, CPI and PPI, both of these reports were basically kind of pre-tariff. Okay, so there's some degree of truth to the argument that, well, you can't 100% say that because the market's smart enough to realize that those reports don't mean much. I would argue it just paints further context to the picture that it's like, okay, well, pre-tariff, if we were already in a disinflationary sort of world, right, where CPI is falling, PPI is falling, if that was already the context, and then we took tariffs increased tariffs by 10x, what they normally were, and entered a global trade war, and added even further disinflationary pressures, bonds should be getting bid even harder, which just makes this move over the past week or so even more paradoxical, even more kind of concerning. So again, I think that's pretty much everything I want to cover. But again, I want to point people to so for Fed funds, we've been talking about this. I think I covered it in my video last night, but can't find it. Here we go. So for Fed funds will be a thing to keep an eye on. If you have a Bloomberg terminal or follow like Zero Hedge, people that do have Bloomberg terminal, they have access to much more up-to-date SOFR spreads. This indicates kind of the stress in the actual financial system. This indicates the stress in liquidity conditions and for the banks. So this would be one thing to watch for that. And I would also, again, remind people, we've been banging this drum, but I will remind people again, this is the 10-year break-even inflation rate. This is an inflation, it's a swap. It's a derivative contract that basically shows you the expected inflation, right? Liberation Day was here. What does it say? 228. We are now 10 basis points lower. So the market is expecting 10 basis points lower of inflation, which means that this move higher of 50 basis points, 55 basis points in the 10-year is actually 65 basis points in the wrong direction, right? Because it should have been, at the very least, 10 basis points lower. The 10-year yield should be 10 basis points lower. But instead, it's 55 basis points higher. So if anything, this move is 65 basis points in the wrong direction. Let's look at this. So this is the CSI 1000. This is one of the Chinese indexes, stock indexes. And this was kind of yesterday, right? It's market's been closed in Asia for a while. But China showed strength. Nikkei, which is Japan, showed weakness. This is another Chinese index, which also was kind of showing strength. Kospi, which is Korea, relatively flat on the day. Hong Kong, relatively flat on the day. Stocks, which is Europe, down 1.7%. DAX, which is Germany, down 0.7% on the day. IBEX, Spain, basically flat on the day. CAC, which is France, down marginally, down 0.5%. UK, basically flat on the day. So yeah, hopefully that was helpful. We'll probably end up doing another update probably at the end of the day. This seems like things are kind of heating up, and so yeah, there's there's a lot to cover. This is incredible. This is incredible. Look at that weekly candle on the 10-year yield. Wow. This thing is clearly breaking out, like from a TA perspective. We had this kind of downtrend here, and the 30-year yield is breaking out, the 20-year yield is breaking out to the upside. Given what is going on, that is insane. Let's go through rates, global rates. So here's the Canadian 10-year. On the day, it's up about 3 basis points, so nowhere near the 10-year, which is up at time of writing 13 basis points, which is crazy. Australia, their 10-year is up 6 basis points today. Great Britain is up 9 basis points, almost 10 basis points. So there's if there's a close parallel, it's probably gilts. We've been saying that for a few days now. Germany is down 8 basis points. France is down 3 basis points. Spain is down almost 5 basis points. Italy is down 2. China is down. Oh my God, look at that. The story out of China, I mean, I think it's safe to say we're in a capital war, currency war. Watching China and watching the CNH, like we know this is a managed currency. We know I've been speaking for a long time now about the need for a Mar-a-Lago Accord, the need for a global monetary reordering. I firmly still believe, if anything now more than ever, that that is one of the inevitable conclusions out of all of this. Is a something monetary reordering, call it whatever you want. It'll probably take place at Mar-a-Lago if I had to guess. Mar-a-Lago Accord. So yeah, these are some wild moves. A dollar's down 1%, and it broke this support. Like it broke that support. Now it's rallying a little bit off the lows, but this thing, like on a week, this is a weekly chart. That does not look good. That it broke this long-term 1, 2, 3, 4, 5 times support. The fact that it broke through that. Let's look on the daily. It just knifed through it too. It didn't even try to bounce. Look, there's no topside wick on this daily candle. It's just been all down. It's getting bid down here. Who knows what that's, another thing I think is just kind of theorizing. I could see a world where, given all this, right, we're currently, call it in a capital war and in a currency war, foreigners are clearly dumping bonds to some degree. I can't say that's 100% of the move in long-term bonds, but it's certainly a significant portion because the dollar is down so sharply. I could see a world where Trump, who is very nationalistic, goes to the banks and says, look, this is a war. This is a war. It's not a kinetic war, but this is a war. We need you to step up for America. We need you to step up for the country that did so much for you. We need you to buy the bonds. Sure, they can create a program or they can create this or that, right? Acronym. But just kind of on a moralistic level, he might go to the banks and frame it that way, which, is not really an incorrect framing, in my opinion. So, who knows? Maybe that ends up coming true. But this is incredible. Oil's down again today. Again, if the move higher in rates was due to inflation, due to nominal growth expectations, oil would not be below 60. Inflation swaps would not be down sharply. Like this looks like, just from a TA charter's perspective, this looks like it wants to head lower. So yeah, like inflation swaps, oil are clearly indicating that this is not a higher nominal growth story. That is not why rates are going up. Rates are going up because of fiscal and because foreigners are rotating out of US dollar assets and the dollar is no longer serving as a safe haven bid. I would point out, like I had a very brief conversation with Luke on X where I asked him, if this is just a normal deleveraging, like some people are saying, right? It's just don't worry, this move in rates, everything's fine. It's just normal deleveraging. I said, like, why would the dollar be dumping so hard, right? If it's just a bunch of domestic hedge funds in the US deleveraging, right? A VAR shock, and they're just deleveraging. Why would the dollar be down so sharply? And he said, basically, to paraphrase, exactly, the dollar would not be down. If anything, the dollar would be ripping higher. So again, we've always said that there's some component of all of this that is kind of a broad-based deleveraging. But you don't see the dollar dumping to the degree that it is in just a normal vanilla deleveraging of U.S. hedge funds, U.S. banks. That is not the full story. Anyone that's telling you that the full story, I would say ask them why the dollar has moved so sharply lower, because normally in those sort of conditions, the dollar would be moving higher, not lower by 3%, knifing through any and all kind of semblance of technical support. So hopefully that was helpful. We'll keep an eye on everything, probably do another video later. But and if anyone has any questions about terms, concepts, anything, please leave a comment. The whole point of this YouTube channel, the whole point of my X account initially, and still to this day, was to help try to, I've spent, I don't know, 30, 40, 50,000 hours nerding out on all this stuff. My view was like, well, God, normal people don't have that kind of time or energy or attention like you shouldn't have to spend that much time and energy to understand the financial system, the system that runs your life and your family's life. So my entire goal is to be able to break things down into like everyday English, simple English for everyday people. So if there's any concepts that might have brushed over, gone too fast, not explained fully, please let me know. But yeah, we'll continue to watch this. It's definitely going to be another exciting day, probably.